Imagine you go to a family wedding and there is that one rich cousin. Let's call him Vicky. Vicky is wearing a Rolex. He's driving a Porsche and buying drinks for everyone. If you look at Vicky, you think, whoa, that family is rich. But if you look at the other 50 people in the room, they are struggling, they are broke, and Vicky is masking the reality of the entire family. Right now, the stock market is pulling a Vicky on you. If you look at the Sensex or the S&P 500, they are hitting all-time high, right? The news headline screams bull market. But if you look at your portfolio or the stocks in the mid-cap or small-cap space, many are down by 20 to 30% or absolutely doing nothing. Why is the market green but your portfolio is red? Because you are looking at a hollow market. And in this case study, I'm going to teach you the single most important concept of 2026, which is market breadth, and why are the generals are charging forward but the soldiers have already retreated. To understand this trap, you need to unlearn something. Most people think the Nifty 50 or the S&P 500 represent the economy. No, it does not. It represents a math flow called market cap weightage. And here is the new learning for today. In the US market, just 7 companies like Apple, Nvidia, Microsoft, Google and etc. make up nearly 30% of the entire index value. In India, it is similar. Just a handful of high weighted stocks like Reliance, HDFC, Infosys dictate the direction of the Nifty. And the trap, if these 5 to 7 companies go up by just 1%, the index looks green. Meanwhile, the other 493 companies can go down by 1% and you don't even notice a thing. The index is lying to you. The rich cousin is getting richer, masking the fact that the rest of the family is going bankrupt. Traders have a name for this. We call it divergence. Think of a bull market like an army marching into battle. The soldiers, who are they? Those are the thousands of average stocks like mid-cap, small cap or the banking stocks. And who are the generals? These are the market leaders like the tech giants or the conglomerates. Now understand a healthy market, which was 2003 to 2020. The generals charged and the soldiers follow. Everyone makes money. That was a real bull run. A hollow market which is of now. The generals are charging forward alone. They are hitting all-time high. But the soldiers, they are quietly retreating. They are breaking every support level. And here is the history lesson. We saw this in 2000 dot-com bubble. We saw this in 2007. The generals are always the last to fall. And the smart money, the institution, sells the soldiers first quietly. Then they pump the generals to keep the index green so you, retail, can stay calm and keep buying. Then they shoot the general. So how do you spot the lie? You stop looking at the price and start looking at the breadth. I want you to add a new indicator to your toolkit today. It is called the advanced decline line or the AD line AD ratio. It's a simple metric. How many stocks went up today and how many stocks went down. And it creates a secret signal. If the Nifty or S&P makes a new high, but the advanced decline line makes a lower high, that is the loudest alarm bell in finance. It means the rally is narrowing. The fuel is running out. And right now in both the US and the part of the Asian markets, we are seeing this divergence. The index is flying, but the participation is dying. Why does this matter for 2026? Because when the generals finally correct, when Nvidia slows down or Reliance takes a breath, there is nothing left to hold the market up. The soldiers are already dead, and that will create something called liquidity vacuum. When everyone rushes to sell the top 7 stocks at the same time, the index doesn't just dip, it crashes, because the passive investors, the SIP crowd or the ETF crowd are blindly buying the generals. And when the panic strikes, the selling pressure is concentrated on the only thing holding the roof up. The lesson here is simple. Don't confuse the index with the market. Just because the Sensex is up doesn't mean it's safe to buy random stocks. Your action plan would be to check the advanced decline data daily, which is available on NSE or TradingView at no cost. If you see the index green but the declines are higher than the advances, do not buy. That is a trap. Be extremely careful with the generals, the overcrowded stocks. they have the farthest to fall. The market is currently a beautiful house with termites eating the foundation. It looks great until you lean on the wall. And if this video helped you see through the illusion, hit that like button, subscribe, because next week we are going to look at the only asset class that benefits when the generals fall. See you in the next video.